What's good, YouTube? It's your boy Teflon Don, aka the founder of OTG, Only Traders Gang. And today, gonna be posting my first video. So, with that being said, we're gonna rewind it back to the beginning and start with the basic, the basic place where you should go to understand what Forex is, what it means, why it's there, how it affects us, etc. And it does affect everyone, whether you know it or not. So here we have babypips.com. That's where we are. And basically, this is a free educational platform where you're going to be provided with everything you need to know on a basic level for Forex. This is something that you can use as someone who doesn't have any understanding or doesn't even know what the term Forex stands for. So I'd recommend you use this platform. It's the best tool and it's free. That's why I use it. Or that's why I used it, because it's free. So we get into the next page. So yeah, you just have a tracker which is gonna track your progress, how many lessons you've done. You've seen I've taken a few myself. I had another laptop where I also completed the course. But right now, where I'm at, having just the basic knowledge of Forex, this course isn't that useful for me, but it's always nice to like recap and study. Just go over things again, get the basics, go back to the basics. Make sure you get them. Have that strong base. So now we continue to the course. You just click continue to the course, simple as that. And it's going to show you the different stages of the course. So right now at a preschool level, that's literally the beginning. And it's going to go straight into what is Forex. It's going to give you a summary of what you're going to be studying, what is Forex, what is traded in Forex, buying and selling currency pairs, Forex market size and liquidity, the different ways to trade Forex. So for us today, we're going to stick to that. I'm going to stick just to the beginning. So let's get into it. You just click it, we in it. So here's a basic definition of Forex, and I'll read it out for you guys. It says, quite simply, it's the global market that allows one to trade two currencies against each other. If you think one currency will be stronger versus the other, and you end up correct, then you make a profit. Make a profit. If you end up wrong, you're going to make a loss. Just reality. Face the facts. So if you've ever traveled to another country, usually I had to find a currency exchange at the airport and exchange that money in your wallet for another currency. So when you go up to the screen, of course, airports, currency exchange centers, banks, usually going to see them displaying the different exchange rates for that day. And the exchange rate is the relative price of two currencies from different countries. So let's say, as the example they've given, you find Japanese yen and think to yourself, wow, my $1 is worth 100 yen and I have $10, I'm going to be rich. When you do this, unknowingly, you've participated in the foreign exchange market because you've traded one currency for another. And now, depending on how much time you spend on your holiday destination, you might come back and want to get your native currency back, and you'll see that your native currency actually got weaker and the currency that you exchanged it for got stronger. And now when you turn it back, you're getting more money. So what is Forex? The Forex exchange market is the largest financial market in the world. It's a global decentralized market where the world's currencies change hands. and exchange rates by the second, so the market is constantly in flux. It's a very volatile market with a lot of volume. As you can see, as you go down, you read down, there's about 6.6 trillion per day. Estimate will say about 7 trillion a day that's being moved throughout the market. So with that amount of money being moved throughout the market, there's always an opportunity for you to take a profit. But at the same time, it's going to come with the risk of taking a loss. So you just have to learn how to manage your risk and take your profits. But you'll get into that later on. So when compared to other markets in the world, such as the stock exchange, which trades about 22.4 billion compared to 7 trillion. And it's not a 24-hour market, so Forex market is 24/5. So that's Monday. That's from about Sunday night to about Friday night, the markets are open. Then on Saturday, they're closed. Part-time on Sunday, they're closed, they open. I think with the Asian session, and then, yeah, we're back into it. So it's about 24/5, not 24/7. So like bear in mind when you start trading that if you execute or trade on a Friday and you don't close your trade, that trade is still going to be there after the weekend. So depending on how things go for the weekend, let's say some big news comes out, a new president of America, Joe Biden, decides to lower interest rates or whatever, that's going to affect the price. So you could wake up Sunday and see that you've made a loss and you didn't even set a stop loss. So imagine that. So the currency market is over 200 times bigger. It's huge. When you compare it to the New York Stock Exchange, Tokyo Stock Exchange, London Stock Exchange, if you compare it to the crypto exchanges, the crypto market, how much is being circulated there, it's definitely much, much larger. It's probably like 10 times bigger than all of them combined. So that's how much Forex is really playing a part in our daily lives. So as we go on, that basically lets you know what the market is relative to the size of other markets in the trading space. And from there on, we're just going to keep track of our progress. So what's traded in Forex? Of course, it's money, just money and nothing else. In some cases, they do trade currencies against cryptocurrencies, but usually when we're talking about Forex, we're just sticking to money, to fiat currencies. So when you decide to go long or short on a position, that's basically you investing into that economy. And you're banking on whether that economy is doing well. If you go for a buy, that you're going to buy low, sell high. Or that economy is going to go down. And in that case, you're going to buy high, sell low. So when you buy any currency pair, you're basically buying a share in that economy. So the example that's here, it says in Forex trading, when you buy, say, the Japanese yen, you're buying a share in the Japanese economy. So you're banking on the Japanese economy doing well against whichever the currency you decide to trade it against. And we've got the major currency pairs. There are 8 of them. All of them are here. From the Canadian dollar, pound, euro, yen, Australian dollar, Swiss franc, New Zealand dollar, United States dollar. They're all major currencies. So those are the ones you should probably stick to at the beginning of your Forex trading journey. Just pick maybe 3 or 4 from those 8. study them. As you get better, you add more. And as you become an expert, you can now venture into trading the minor currency pairs, etc., etc. But for me, that's not necessary. For most traders, that's not necessary because all the volume is amongst these currency pairs. They're the best currencies. So that's where the most movement is going to occur. And as you can see, it states right here, for us rebels, we gang, we rebels, we're just going to list them all as the major currency pairs, even though they aren't, but they basically are. So yeah, we just have a breakdown of how the pairs are named. You should know this. This is very important that you know which currency pair you're trading with to avoid any confusion, any losses. We're just always trying to avoid losses in Forex, run up the profits. So currency symbols have 3 letters, as you can see, and that's the country name and the currency name. So they take the 2 letters from the country and the letter from the currency, then that's what names appear. Fun fact, did you know the British pound is the world's oldest currency that's still in use, dating back to the 8th century? The newest currency in the world is the South Sudanese. Now that's inaccurate, because where I come from, we got bar notes, even though they ain't on any exchange. In my country, that's the legal money. So next. So now we go to buying and selling currency pairs. So yes, basically Forex is the simultaneous buying of one currency and selling another. And this happens through a broker or a dealer. So when you get into Forex, just know you can't just inject your money just like that. You're gonna have to go through a broker or a dealer for you to begin trading. So that's something that you learn as time goes on about brokers and dealers, etc. Because the regulated brokers and the unregulated brokers, there's spread, there's liquidity, a lot of things that go into having the ideal broker. So this is basically an outlook of what is basically happening on the market, is that 2 currency pairs are basically in a constant tug of war, pulling back each day. One day, maybe USD is winning, the next day, the euro is winning, and they're just tugging away at each other. Maybe at some point, the US dollar really tugs the euro, but then, as the markets always state, history is bound to repeat itself. So the markets are basically a constant rotation of the same things occurring over time, again and again, because of basic human behavior, the way we behave. So that's the 3 categories. Got the majors, we got the crosses, we got the exotics. But as I said, all you need are these. Going down into the rest, that's up to you, man, but all the money is in the major pairs. So we've got a list of the currency pairs. If you want, you can pause, read them through, take a screenshot, take a picture with your phone. Just have it on hand so that you know. Over time, you just get used to it. You won't have to go back to your phone to remind yourself. And as it clearly states, the majors are the most liquid in the world. Liquidity is used to describe the level of activity in the financial market. And Forex is based on the number of active traders buying and selling a specific currency pair and the volume being traded. The more frequently traded something is, the higher its liquidity. E.g., more people trade the Euro USD pair at higher volumes than the Aussie USD currency pair. This means the Euro USD is more liquid. So currency pairs that don't contain the US dollar are known as cross-currency pairs or simply crosses. Major crosses are also known as minors. So major crossing pairs, such as maybe you'll have GPY, GBP, something like that. That's going to be a major minor. Basically, it's going to be a major minor, or it's going to be a cross, a major cross. And while it's not traded frequently, the crosses are still pretty liquid and still provide plenty of trading opportunities. So even within those pairs, there are a lot of setups that can be made so that you can plan your entries and your exits. And these are the euro crosses. We go down, euro crosses, yen crosses, pound crosses. If you want to look at that, you can just pause, go through it. It's just the currency pairs, basic. It's just going to show you the currency pairs, some of the Forex lingo. So if you have maybe dollar rand, you know, people are talking about USD against the South African rand, etc. So due to the overall lower degree of liquidity, exotic currency pairs tend to be far more sensitive to economic and geopolitical events. For example, a political scandal or unexpected election results can cause an exotic pair's exchange rate to swing violently. And within that violent movement, there are a lot of people losing money and a lot of people making money. There's more pairs, but like this is just, and we don't even this is a bit backdated. In Zimbabwe, they don't even use the Zimbabwean dollar anymore. It's now the bond notes. Just food for thought. So keep going down. All these G10 currencies, etc. It's not really important. It's not really gonna make up the base of your Forex trading part. So here basically states the bulk of Forex trading takes place on what's called the interbank market. So unlike other markets like the New York Stock Exchange or London Stock Exchange, the Forex market has no physical location or central exchange. The Forex market is considered over-the-counter market due to the fact that the entire industry is run electronically within a network of banks continuously over a 24-hour period. So the market is spread all over the world, basically. It's not in one location. Unlike the New York Stock Exchange, you go to New York, you can go into the physical building. There's no physical building for Forex. It's just a whole lot of big banks running the market. So this is just going to break down how it's divided, how most of the pairs are traded by who, where the retail traders, so we're the small traders, man. We're not that important. But even though we're eating the crumbs, it's a lot of big fucking crumbs, man. So in this case, the dollar is the king in the market. The dollar is the king. Every pair is always tracked according to how it goes against the dollar. And this happens because the US dollar, the United States economy is the largest economy in the world. I'm sure we all know that. The US dollar is the reserve currency of the world. I don't know who they're reserving it to though, like aliens or something, I don't know. The United States has the largest and most liquid financial markets in the world. The United States has a stable political system. The USA is the world's sole military superpower. The US dollar is the medium of exchange for any cross-border transactions. E.g., oil is priced in US dollars, called petrodollars. So if Mexico wants to buy oil from Saudi Arabia, it can only be bought with the US dollar. If Mexico doesn't have any dollars, it has to sell pesos first and buy US dollars. So speculation in the market. That's basically what we're always doing. We're speculating, trying to come up with probabilities, etc., so that we enter our trades. So, in other words, most of the trading volume comes from traders that buy and sell based on the short-term price movements of currency pair. The trading volume brought out by speculators is estimated to be about 90%. And the scale of the market means that liquidity is really high and the volume is really high. So it makes it easier for anyone to buy and sell currencies. Because as I told you, if it's not liquid, it's going to be hard to buy or sell that pair because people do not want it. It's not in demand, basically. So you might have something valuable, but if nobody wants it, then what's the point? So liquidity, very important, because that's where you're going to look for your setups in liquid situations where there's high trading volume, you're spotting momentum, etc., etc. The markets are moving. Unlike on a day where the markets aren't moving, it's better to just, trade another day than to look for something that's not there, if you get what I mean. Looking for a setup that's not there because you want a quick buck, it's not going to work. You lose money. And now we go down to the different ways to trade Forex. So the different ways to trade Forex. From here we've got different ways to trade currencies. Currency trader, spot FX, retail, the most popular forms of traders. Of brokers. So yeah, we have to go to our brokers. You find your broker. That's the institute that's gonna provide you with the opportunity to trade in the market. You got currency options, currency ETFs. But I'd rather go into the different types of trading. So we have 3 different types. We've got day trading, which is personally what I do. I prefer to day trade. We've got swing trading, which is over a longer period of time, 2 weeks to about a month. And then you've got long-term trading where you're buying something in the hopes that 6 months to a year from now, you'd have made some money. So that basically goes into the introduction to Forex. And we'll get into more depth about the other forms of trading as time goes on. But I just wanted you guys to get just the basic prerequisite that you're going to need to start trading. And Baby Pips is a great platform that's free, where it's going to provide you with all the educational tools you need, all the knowledge you need to build a basic understanding of Forex and have that solid base, so that when you're learning other shit, you're just going to be going back to what you learned at Baby Pips for that base. And from there you're just working yourself up. Unlike now, maybe you've decided to take a course, and on that course they're teaching you about Fibonacci. How are you gonna know Fibonacci if you don't even know what spread means, or what a bid is, or what a stop loss is? You know, how are you gonna know what Fibonacci is? Because that's a more complicated term. So as time goes on, there's things that we'll get into, and hopefully we can grow together. You know, this is a gang. It's more than a community, bigger than a family. We gang gang. Let me sign out.